Hi everyone, I hope you had a great week and I welcome you all back to my channel with a fresh new video. The topic that I'm covering today is related to valuation and it's called PWERM. PWERM stands for Probability Weighted Expected Return Method. It is a method used to arrive at a value of securities or their per share value, mainly for startup companies with complex capital structure. Now, first let's try to understand how this method is any different from the traditional approach to value a startup. So the most common approach to value a startup is the VC approach, where you look at the exit value of a company and then calculate its present value. PWORM, go through the same process, but instead of considering one scenario, it consider different scenario. The different scenario could be on the basis of what if a company goes for IPO, what if a company goes for M&A, what if a company goes into bankruptcy or into dissolution. So we consider different scenario and give a probability to each of the scenario. So first let's go through the definition followed by the calculations. So the PWORM estimates common equity value based upon an analysis of various future outcomes such as IPO, merger or sale, dissolution or continued operation as a private viable ongoing enterprise. The allocated value is based upon the probability weighted present value of expected future investment returns, considering each of the possible outcome available to enterprise as well as right of each security class. Capital structures involve multiple class of securities, generally with conversion features such as convertible preferred equity, convertible debentures, are often found in startup enterprise funded by VC. Typically, investors receive preferred stock for cash investment in the enterprise, whereas initial issuance of common stock are primarily granted to founders for nominal or no cash consideration. In addition, employees are often granted option to purchase the enterprise's common stock, a typical capital structure of a startup backed by VC. So first let's understand the steps in PWORM before going to the calculations. The first step is determination of future outcomes that we discuss IPO, M&A, dissolution, etc. Estimate the future equity value under each outcome. So what would be the value if a company goes for IPO? What would be the value of a company if it goes to bankruptcy, etc. Third step is allocate value under each outcome. Fourth step is probability weigh each outcome. So let's say the probability for IPO is 30%, the probability of M&A is 30%, and the probability of going to dissolution is 40%. Now, because we are arriving all of these value at the exit date, let's say 5 years down the line. So in order to calculate the present value, you will discount it and then additional adjustment, let's say adjustment related to marketability discount. All right, now let's move to the calculation and we are going to follow all these steps that we discussed. I have considered five scenarios. The first scenario is IPO, second scenario is M&A high, M&A mid, M&A low, and dissolution. Okay, let's discuss why I have considered these three scenarios in M&A. So let's say my company is a IT company and it is developing four products, all four products in R&D stage. So in case if the company is able to commercialize all its four products, then I might go for an IPO. If out of four it is being able to commercialize three products, then high. If two products, then mid. If one product, then low. And if the company is not able to commercialize any of the product, then dissolution. All right, so these are the scenarios. For each of the scenario, I have assigned an probability. So for IPO, 10% probability, M&A high 20%, M&A mid 30%, M&A low 15%, and dissolution 25%. The total is coming to 100%. The timings in year, standing today, in 4 years, I am expecting an IPO. In 3 years, I am expecting an M&A, and in 1 year, I am expecting dissolution. So basically, for each of the scenario, I have assigned an exit value. This exit value, although the calculation of exit value is not part of this exercise, but exit value you can calculate on the basis. For example, in the case of IPO, you can look at the comparable companies that have recently went for an IPO. So for M&A, you can use the exit multiple approach, and for each of the scenario you can look at the revenue or earning in case if one product is being commercialized, two product is being commercialized, three product is being commercialized. In the case of dissolution, since these products are intangible and has no value in case if they're not able to being commercialized, that's why I have assigned a nominal value of around 100,000. So all of these number are in million. Okay, now the second assumption that we are considering is that the management believe that the company would need to raise 20 million in Series C financing in order to reach a sale or an IPO exit. Based on discussion with investors, management indicated that company would be likely to succeed in raising the Series C at a price of 1.75 per share with similar terms to Series B, which means to say that Series B and Series C are pari passu. If the company meets certain milestone, if the company does not succeed in raising its investment, management estimated that company will dissolve in 1 year. That's why the dissolution we have considered in 1 year in case if they are not able to raise Series C. So let's discuss on class of equity and preferred liquidation preference. So in my example, I have considered common stock, Series A convertible preferred stock, Series B convertible preferred stock, and Series C convertible preferred stocks. Now, in a more complex capital structure, you can expect options with different strike prices, warrants, uh, preferred stocks that are participating, etc. Okay, now for each of the class of equity, I have assumed certain number of outstanding shares, the liquidation preference per share, and what would be the total liquidation preference. Okay, and of course that is only applicable for preferred shares. Okay, now let's discuss certain important assumptions. So the the following should be noted. In the IPO scenario, all classes of preferred stocks are automatically converted into common stocks, and the aggregate enterprise is allocated on pro rata basis. This is very obvious. In the sale high scenario and sale mid scenario, it is advantageous for holder of preferred stock to forgo their liquidation preference and convert to common. In the sale low scenario, it is advantageous for the holder of Series A preferred stock to forgo their liquidation preference and convert to common, whereas it is beneficial for holder of Series B and Series C preferred stock to receive the liquidation preference. So we'll see when it is beneficial to convert or remain as preferred shareholders. So this is the total exit value. So I'm going to calculate the per share value in each of the scenarios. So this is the exit value divided by the total number of shares. Since this 25 is in million, first I'll multiply by 1 million. Okay, so this is the per share value 6.2. So in IPO, if everyone convert into equity shareholder, this is the per share value. Similarly, high scenario 4.2, 3.4 in the case of mid scenario, and in the case of low scenario, it is 1.4. Now, if you look at the liquidation preference per share, in the case of IPO, it is at 6.2, which is higher than any of the value. 4.2, again higher than any of this value. 3.4, higher than any of this value. But in case of low scenario, although it is higher than 1, and 1 is basically pertaining to Series A. However, for Series B and Series C, it is 1.5 and 1.75 respectively. So in case if they convert into equity, they will receive a value at a rate of 1.4 per share. Whereas in case if they remain as preferred shareholders, they will receive a value at a rate of 1.5 and 1.75 respectively for Series B and Series C. So it is beneficial for Series B and Series C to not to convert and receive the liquidation preference. All right, I hope all of these points are clear. The last point is basically saying that in the case of dissolution scenario is applicable when the company is not able to raise the Series C round, And in that case, the series A and series B will basically on a pari basis will receive the liquidation preference. Okay, having discussed that, let's move forward. Now let's allocate the value. So first is the expected enterprise value at liquidity. So I have just simply linked at the top, which is the exit value in each of the scenario. And we know in case of IPO, none of preferred shareholders is receiving liquidation preference, but they're all going to convert. So liquidation preference for Series A 0, for Series B it is 0, for Series C it is 0. So no liquidation preference in case of IPO. In the case of sale high as well, no liquidation preference. In the case of sale low, no liquidation preference. In the case of sale low scenario, we discussed that it is beneficial for Series B and Series C to remain as preferred shareholders and receive liquidation preference. And for Series A, it is beneficial to convert into equity. Okay, so Series B will add liquidation preference. So Series B liquidation preference is this. Since everything is in million, so I will just divide it by million. Okay, and in case of Series C, the liquidation preference is around this. Similarly, I'll divide by million. So we have the liquidation preference. Now in the case of dissolution, the Series A and Series B will receive the value on a pro rata basis. Your value is this divided by sum of this and this, which is the total number of shares held by Series A and Series B. That is 43% multiplied by this value. And in case of Series B, Series A plus Series B, that is 50% multiplied by the total dissolution value. So if you see, the total is coming to 0.1, which is 100,000. So this is the value for Series A and Series B in the case of dissolution. So no value for dissolution because we are assuming that the dissolution scenario will come in picture when the company won't be able to raise Series C. Okay, now this value over here is basically the value after liquidation preference, and this value is now available for equity shareholders. So the formula that I've used is the total value minus sum of the liquidation preference. So in case of IPO and high and mid, it's the same. In case of low, basically it has reduced to 19.88 because the liquidation preference have been allocated to Series B and Series C. And in the case of dissolution, there is no value left for equity shareholders. Okay, now we are going to allocate these value on the basis of the number of share held by each class. So first the common shareholder, so that would be the number of common shareholders is this divided by the total number of shares. I'll freeze this. This is 28. We'll drag the formula. Okay. To ensure everything is right, we will just calculate the total. And see if it is coming to 100. All right, it is coming to 100. Now in the case of high scenario, the same percentages are applicable. Similarly for the mid scenario. However, in the case of low scenario, since Series B and Series C are not converting. So this 20 million is only applicable for common shareholders and Series A. So the value for common would be common shareholders divided by sum of the common and Series A. This is 60, this should be 40. So this divided by sum of the common stock number of shares and Series A. This is coming to 40. Total is 100. And in this case, there is no value applicable, so I'll just make it 0. And in the case of over here as well, there is no value applicable to Series B and Series C, so I'll make it 0. Just convert to percentage for better representation. All right. Now we are going to distribute the value. So that would be this. I'm going to freeze this, multiply by this. Okay, this we have to freeze the rows instead of columns, so I have freeze this. Now again I'm going to drag the formula. Okay, this looks right. The total should be 250. So again, as a check, we can add a total row and do the sum. And your value should match. So 250, 250, 170, 170, 135, 135, 19.880. Okay, so this is done. Okay, now we are going to calculate the aggregate value allocable to each class. So for common, anyways, it's just the value allocable to equity shareholder. So I am going to link. And in case of Series A, it's going to be the sum of the value of liquidation preference plus the value through equity participation. So it's going to remain the same as mentioned in this table. But let's say in case if the preferred shareholder is participating, then they can receive the value both from the liquidation preference as well as participating with equity shareholders. So this is done. And then I'm going to paste it. Okay, now we have value for each of the classes. All right, now here we are going to calculate the per share value. So the per share value for common is this divided by the total number of shares for common stockholders. I am going to freeze this because this one will remain the same. Okay, I have to also multiply by million because all of these numbers are in million. 6.2 is the common stock value in the case of IPO. I'm going to drag the formula to calculate the value in each of the scenario. Okay, now I'm going to calculate for Series A. Now since all of these are in order, I can just simply drag the formula. Now what I'm going to do is drag the formula. All right, so we have arrived at a value for each of the classes for each of the scenarios. Okay, now we are going to calculate the present value for each of the scenario. So first, the present value of equity allocated to common stock in P1. So first of all, in IPO in fourth year, we know the value for equity shareholders, that is 69.88. All right, second scenario is the M&A high. The exit is in 3 years. So I will link this to 47. The mid scenario again in year 3 and the value is 37, and the low scenario is 11.93. Okay, and in the case of dissolution there is no value. Okay, now I'm going to calculate the weighted average. So the weighted average will be the sum product of this range, which is going to remain the same. So I'll freeze this, and the second range is this range. uh, so this is the future value. Now to calculate the present value, I'm using a 40% discount rate. 40% discount rate is a VC rate of return most commonly used. Technically you can apply a different discount rate for preferred shareholders, which tend to be lower than the equity shares, since preferred shares are less riskier than equity shares. But here, for a simplicity purpose, I am applying a 40% rate across the classes. So I'll first calculate a discount factor, which is 1 divided by 1 plus 0.4, 40% raised to the power 1. Similarly, raised to the power 2, raised to the power 3, and raised to the power 4. I can calculate the present value of expected cash flow, that is this multiply by this. And then the total present value of probability weighted cash flow, that would be the sum of all of these cash flows. The total number of shares, outstanding shares, is for common shareholders is around 11 million. Now the common stock value is this, since it's in million, so multiply by 1 million divided by the total number of shares. Now this is pre-marketability. I'm assuming a marketability discount of 30%. So considering this, so applying a discount of 30%, the common stock value per share on a non-marketable basis will be this multiply by 1 minus this 30%, which is 0.63. So now we have the per share common value. Now we can do the similar adjustment for series A and series B. So series A value allocable is, so again similarly in year 4 the value allocable for series A is this value, the high scenario, the mid scenario, and the low scenario. Dissolution, although the value is very low, but we'll still consider. Okay, just ignore this note, everything is in millions. Drag this over here and stretch the formula. Okay, Since the present value, since the discount rate is same, so I'm going to link from the top, and then we can calculate the present value of expected cash flow. Let's multiply by this. The total value is the sum of this value, the total number of shares. Let's change the heading, total number of Series A shares. This is the number of total Series A shares. So this multiply by 1 million divided by the number of shares. It's coming to 2.89 using a 40% discount rate. I think being technically right, we should use a lower discount rate than the equity shareholder. So let's use the 20% discount rate and then calculate. So it's not going to take time. Let's calculate discount factor. So 1 divided by 1 plus 0.2 raised to the power 1 raised to the power 2 raised to the power 3 and raised to the power 4. Now the per share value is 1.46 pre-delom. Now in the case of delom as well, similar to discount rate, the delom per preferred shareholder should be lower than the equity shareholder because the preferred shareholders are more marketable, more liquid. So I'm going to assume just 10% delom for this, and just use the same formula. So I'll type 10% and this is 1.32 is the value of preferred shareholders for series A. Okay, now let's calculate the present value for series B. So the IPO value for series B is this value. This is the mid case. So this is the M&A high case. Mid case, low case, and dissolution. Okay, again I'm going to use 20% for preferred. So the discount factor is, okay, discount factor now I can link. And the present value of expected cash flow is this multiplied by this. Okay, the probability weighted, okay, the probability weighted cash flow we have to calculate. I'll simply again copy paste the formula and drag this to over here. Okay, now I have the present value. Let's calculate the total present value, which is coming to around 15 million. Number of shares for series B is 10 million. The per share value pre-delom, this multiply by 1 million. divided by the number of shares. So it's coming to 1.5. Now let's apply a delom of 10%. Let's copy paste the formula from the top. Alright, so the per share value of series C is 1.35. Okay, the last thing left is in case we have to summarize the present value across each of the classes, then I'll just simply link to the top. So this is the present value in case of equity, present value in case of series A, and series B is this value. I'll add this up. Alright, so the total value as of today of the company is around 37 million. So that is with today's topic. I hope, as always, you had a great learning session, and I see you the next time. Thank you so much.